Hello, I'm Ellie Dowding.
And I'm Lee Coates. Together we are ESG Accord and the Accord Initiative.
You're listening to Accord Talks, a podcast about sustainability, compliance, and advice processes supporting the financial advice sector. Okay, this is the fourth and final episode of our four-part mini-series of Accord Talks for Good Money Week. I've
Right.
I know. I've loved each episode in the series so far, but I know that for you, Lee, today's theme is going to be of particular interest with us talking about values in investing.
It certainly is, Ellie. Yep. And it's fair to say we're not short of guests wanting to join us for this one. So today we've got six brilliant speakers, all experts in their fields, who all wanted to take the time to help us unpack what it means to incorporate values into advice in a meaningful and compliant way.
Yeah, it's really great, isn't it? So, but whilst some certainly tested our organisation skills, should we
Just a bit.
say, arranging all the topics and all the speakers for this mini series, or not so mini, actually, I
Yeah.
think that we have certainly captured some of the amazing energy, the expertise and passion that surrounds this area of investing and philanthropy.
Yeah, I agree. And it's interesting you say that, Ellie, because in my experience with clients, good things happen when you speak to them about their values and
Yeah.
preferences when they're investing. Now, if you remember the 2024 Financial Lives survey, 76% of people want to be asked about their views. So that's FCA confirming basically that clients want to be asked. They're the ones that want to make the decision about how their money is invested, even if it's not investing sustainably. The point is, clients want to be asked, and clients are loyal to advisors who take the time to identify and reflect their personal preferences, and they refer and recommend their advisor to their like-minded friends and relatives. And I know this based on 30 years as an IFA.
It's such a good point, and really important for people to hear. Okay, but we had better get started.
Yep.
Yeah, and because we're all about, of course, a good regulatory understanding and good compliance, we are going to hear first from Louisa Chender. So Louisa is a technical specialist for sustainable finance policy in the Sustainable Finance Division at the FCA. We invited Louisa to talk to us today about the positioning for ethical and values-based funds in the sustainability disclosure requirements regime, and also to offer us the FCA's view on pure ethically screened funds and their place in the market. Over to Louisa.
Thank you, Ellie and Lee. This is a great question and one that we are often asked about. We recognise that ethical investing is a common approach, it's a popular approach. As you'll be aware from our previous discussions, one of the key outcomes we're looking to achieve with the SDR and labelling regime is for consumers to be able to navigate the market. And what we mean by this is being able to navigate to all funds meeting their needs and preferences. So they might want a labelled fund that has a specific sustainability goal. They might want a fund without a label that has specific sustainability characteristics, such as an ESG screen fund. And they might also want a fund that makes certain exclusions based on their values. And this is an approach that we have referred to throughout the SDR policy as values-based or ethical investing. We have clarified that throughout the SDR policy, our view is that avoiding certain assets based on values is different to investing in certain assets to deliver positive sustainability outcomes. But having said that, we very much recognise that values-based investment approaches may nevertheless result in a fund having environmental or social characteristics, depending, of course, on the specific values of the consumer. So, a values-based or ethical fund may nevertheless fall under the SDR naming and marketing rules, where those funds have specific sustainability characteristics and they are marketed as having those characteristics. And then what that will mean in practice is those funds will have a consumer-facing disclosure and in time, after a year, they'll have the more detailed product level disclosures as well. And they'll also include in those disclosures a statement to clarify why they don't have a label, just like any other fund with sustainability characteristics. But you may have also noticed that some funds actually do have labels, some ethical funds or funds with ethical in their names. So just wanted to clarify that those funds must nevertheless have met the criteria to use a label. So they might be in effect going beyond what may be associated with a traditional exclusionary ethical investing approach, and they will have included a specific sustainability goal as part of their investment objectives, as well as meeting the other criteria. But the key for these and any other funds is to be clear and to be transparent about what the fund's goals are and what the investment approach is, because ultimately consumers must be able to understand what the product is aiming to achieve and, of course, what it will invest in and what it won't invest in.
Thanks so much to Louisa for her commentary today and for kindly taking the time to join us for the whole of ESG Accords events during Good Money Week.
Yeah, massive thanks to Louisa and the FCA team. Great commentary again from Louisa today. And she clarified something we often hear, that ethical screening can be different from investing for a sustainability outcome.
Yeah, but importantly, she added that ethical funds still have a place in the SDR world. They may not carry a label, but if they've got the sustainability characteristics, they still fall under the disclosure rules. So following on from the first 3 podcasts in this series, we absolutely know how essential the disclosures have already become.
Yeah, and I liked her emphasis on clarity. Consumers must be able to see what the fund will and will not invest in. That's so important when we're talking about personal values. There's a great message for advisors in this. It is that one must be transparent with clients.
Yeah.
Explain why a fund has or hasn't got a label and what that means for their preferences. Okay, I'm ready for our next guest.
Me too. So our next 4 speakers are all fund or product and services providers, and we wanted to find out more about how they deliver values-based products and services in light of the SDR. So we're starting with James Cora. James is Head of Sustainability at CCLA. Over to James.
Hi, Ellie and Lee. Thank you so much for inviting me onto Accord Talks. I mean, I guess the starting point, of course, is that in some ways, values has become a little bit of a dirty word in our industry at times. So many of the organizations have talked about materiality as being the future of our industry, rather than actually focusing in on connecting people's values with their money, which for me has always seemed slightly strange, because one of the key drivers for this industry from the start has been the idea of values alignment. So the fact that we're going back to that, I think, is really positive. Of course, SDR in many ways is slightly immaterial when it comes to values, because often when we're talking about values, we're talking about screened funds. And of course, those funds are not covered under the labeling regime, principally because they don't necessarily on their own have that dynamic approach to driving change that SDR is looking for. Of course, though, so many of them are underpinned by engagement strategies, etc., which do try and do that. So I guess in many ways, the big change that SDR has brought about is just making sure that those prospectuses and legal documents are watertight and creating the ongoing disclosures, particularly as some of those funds do begin to fall into the sustainability characteristics bucket, given the other things that they do. I guess the bigger point for me is it does show actually that values is still a really key driver for the large number of people who are selecting into sustainable or responsible investment solutions. The recent FCA Financial Lives data showing again that actually, we've got really excited about sustainable or themed funds or impact funds, but actually a lot of people are just looking to avoid things that they continually disagree with. So I think in many ways, whilst SDR has allowed us all to tighten up, particularly on the sustainable part of the business, we can't forget that screened funds really matter, and they'll be a key driver for what people are trying to buy in the future.
Thanks so much to James for joining us. always with the wise, insightful words. He reminded us that values were the starting point. I love that. It's easy to forget when everyone's talking about materiality and frameworks.
Yeah, I agree. I think he's absolutely right as well in pointing out that screened funds remain hugely popular.
Mhm.
Clients often want to avoid what they disagree with. Whether this is best for ultimate outcomes is, of course, one for a very long and emotive debate.
Yeah, not today. Not today.
Yeah, but I think that screens can give a client a sense of security to their own values.
Yeah, for advisors, this is a good reminder. Don't underestimate the importance of negative screening. It's still one of the strongest and simplest ways to align money with client values.
Agree. Personally, I think a screened fund with the fully available SDR disclosures is a very valuable thing to have in an advisor's toolkit. Okay, let's move on. Our next guest is our brilliant friend, Miranda Beecham. Miranda is the head of UK Responsible Investment at Aegon Asset Management. Over to Miranda.
Hi, Leonelli. Thanks for inviting me onto Accord Talks. It's really interesting to come and talk to you about how to deliver a values-based fund in this new SDR world and what changes that we may have had to make on how we've marketed our funds. Well, I could answer that kind of quite shortly. Really, nothing much has changed. We were initially concerned that SDR labeling would mean that the ethical funds would be kind of edged out of the market, because they really couldn't get a label due to the fact that they have a very simple structure of excluding certain sectors rather than creating an intentional standard. So we did consider altering the fund to create a standard, but we felt that that actually wouldn't really be true to the concept of what an ethical fund is. People still greatly value the simplicity and unambiguous nature of these funds. So we took the decision to assign it into the unlabeled with sustainable characteristics category. That was very quickly accepted by the FCA, and we've continued delivering funds that are aligned with the client expectations ever since. We launched our regular ethical survey in the past year. We gathered the feedback on the current structure of the exclusions, and we have made some minor changes in response to that survey, and therefore have continued on as normal. Obviously, the SDR regime is not just about the labels. It also includes anti-greenwashing, naming and marketing provisions. So we have done a thorough review of the marketing materials to ensure there was nothing in there that could be misleading. But really, being in that unlabeled category allows us still to talk about the strong ESG credentials that the funds do have, such as the very low emissions in comparison to the indices. And also part of being in that category is the requirement to produce a consumer-facing document, a short and clear document outlining the objectives, the structure and the ESG characteristics of the funds. And this, I think, is probably one of the strongest points of the regime. It allows clients to read a short 2-page document to really get to the essence of the product that they're investing their money in. So, in answer to the kind of question that you posed to me earlier of how we are delivering values-based funds in light of SDR, the answer is we're continuing as we always have, listening to client opinions, managing the fund in light of that, and marketing in a very clear and unambiguous manner.
Thanks so much to Miranda for sharing her views. Now, one of Miranda's points really landed with me. Sometimes the simplest structure is the strongest structure. Their ethical funds haven't changed under SDR, and clients still value the clarity of exclusions.
Yeah, it's a really strong message, isn't it? You know what I also liked about her commentary? It was the comment right at the end about listening to client opinions. I'm always going back to the Consumer Duty, looking at it through the lens of Consumer Duty, and it's this point from Miranda. It's everything. So I love that Aegon Asset Management conduct their annual ethical investment survey with their investors, and they report on it and formally review their ethical screening every 2 years. It's great.
Yeah, completely agree with that one. And on similar lines, she praised the 2-page consumer-facing disclosures. We've been saying this all week in different ways, but I'll say it again. If you're not using the consumer-facing disclosures in client meetings and research, you're missing an easy win.
Agree.
Okay, moving on. Next, we hear from David Harrison, who is a fund manager at Rathbones Asset Management. Over to you, David.
Hi, Ellie and Lee. Very excited to be here on Accord Talks and talking about our fund and what it's meant through the process of SDR. We've got on the fund, we've got the Sustainable Focus label, which we got in April 2025. I'd say perhaps like others that the process of going through SDR has been very involved, but also very helpful. In many ways, we didn't have to change much. We have a long heritage in this space. And I think our goal at Rathbones has always be multi-thematic in terms of sustainability and backed by a clear and consistent process. We believe a multi-theme sustainability approach offers the best outcome for clients. We want to give clients exposure to powerful sustainable themes such as the energy transition, technological change, water infrastructure solutions, and advancements in healthcare. We also have long heritage in the space with our relationship with Greenbank, and we found this was such an advantage in the SDR process. But I would say that the SDR labeling process did sharpen what we do and how we explain it to clients. So there's lots of natural benefits of going through it. I think at the heart of SDR is explaining and evidencing your standard of sustainability. And this is where we spent most of the time really thinking about what we do, what we can enhance, and that thus benefiting the end client. We back tested all our sustainability framework. And one of the big things we added were a lot more quantitative factors and evidencing those quantitative factors. We know that SDR brings incremental requirements on how you think about a company and how you prove that company is meeting your standard of sustainability. So we really enhanced and involved a scorecard process for each company. This was a huge amount of work, but very fruitful. We believe our scoring approach is clear, quantitative, and backed by significant evidence. We also found this work around the scorecard and scoring enhanced our engagement work. Engagement has always been core to how we manage these mandates, but the process of SDR further quantified and explained our engagement escalation process and which companies we focus on. So again, I think a strengthening of the output for clients and SDR has been very helpful. I think ultimately we always want to provide an investment solution that is simple to understand, has clear and evident sustainability outcomes, and gives exposure to structural change that will benefit investors, we believe. We're already doing this, but SDR has made our proposition even stronger. And I'll just finish off probably around the consistency we have here, in that we've adopted sustainable focus labels, not just on this fund, but on our multi-asset solution and our bond solution. So investors can come to us, whichever asset class, backed by that same process, that relationship with Greenbank. So we would say SDR has been very beneficial from that point of view too.
This was such a super interesting commentary from David. Thanks so much to him for joining us. I think he really explained how well the SDR can sharpen a process. They already had a strong sustainability heritage, but the back testing and scorecard really added rigor to that.
Yeah, that's right. And so interesting how he talked about evidencing the quantitative factors. Considering your comments on a podcast a few episodes ago, Ellie, I think you need to comment more on this.
Yes, I do.
Here we go. Here we go.
I love that David mentioned this. Personally, as you know, I find quantitative measurement reassuring and concrete. I love that. And I think that clients probably do too. So what's great about the SDR is that firms must be able to stand behind any claims they make. So the FCA has not been prescriptive about whether the measurement is quantitative or qualitative, so long as it is robust and disclosed. I think our previous discussion was around the availability of quantitative evidence as a tool for fund selection. And my comments were about the availability of quantitative measurements in areas wider than carbon emissions, for example, used as a way to identify a client's investment preferences for values-related outcomes, potentially narrows down the possible outcomes, or can even exclude areas that may be more aligned to the client's values. you've got to have the softer facts, those conversations with the clients about the softer elements. But of course, all this being said, data availability is increasing across more and more areas all the time.
Yeah, that really is interesting. And thanks for recapping so succinctly, Ellie. And trust me, listeners, that was the short version. Okay, a final note on David's commentary. I thought his point about consistency across asset classes was reassuring. Clients like to know the same philosophy applies whether they invest in equities, bonds, or multi-asset. Advisors can take confidence from that. Consistency makes the client journey smoother and easier to explain. Right, our next guest. Let's hear from Wayne Bishop, who is CEO at King & Shaxson Asset Management. Let's go, Wayne.
Thank you both Ellie and Lee for inviting me to talk on your ESG podcast around the topic of values-based investing, values-based portfolios in the light of the new SDR and what changes we're having to make to adapt to this new regime. Well, the SDR regulation for us is very welcome. It brings a lot of clarity to the impact area, and with it, not just clarity, but very good data, very good full understanding that will help clients. But right from the outset, because we are in a very complicated and nuanced world, the FCA wanted to avoid the area of negative screening, i.e. ruling out certain investments because of either ethical or environmental objections. So, to a certain extent, the SDR regulations allowed for something called engagement, and engagement was where companies in these areas or companies that needed improvement can be engaged, and you can demonstrate your impact through how you engage with companies. But for a number of investors, engagement is not enough. They want to avoid these sectors fully. And the problem with negative screens is once upon a time they may have only been on the fringe of the market, affecting things, say, like pornography or defence and weapons, tobacco production, which are all relatively small sectors in terms of the market cap. But increasingly, a number of investors want to avoid other areas, and these in particular are quite important. So they want to go the full works with animal testing, not just avoiding animal testing for cosmetics, but for all purposes and for all medical purposes. And that has quite a material impact on a portfolio. Likewise with fossil fuels or with polluters and big greenhouse gas emitters, with tax avoiders and companies that have deploy very, very aggressive tax practices, companies with poor ESG records in terms of governance and social. Now, these are not necessarily fully impact, but some of these companies that they want to avoid here could also be high impact companies. And this is where it gets a little bit more difficult for us, because we find ourselves having certain things that have a good impact and certain things that perhaps fail on other metrics. The classic example, the well-known one, is Elon Musk and Tesla, for example. A number of people would like what Tesla does as a company and how it has pioneered the electric vehicle, but do not like the way Elon Musk has gone around business and the fact that he is a social nightmare and a governance nightmare. But this is the classic example, but we have this in a lot of areas. Nuclear power can be another one. So the way we operate portfolios has not changed because of SDR. We have certain funds that already meet the SDR label, the SDR, and what I mean by that is the impact label. We have other funds that have opted for the focus label rather than the impact label, but are still very good in everything they do, so they could be included. We have funds that have opted for no label, and that can be for one or two reasons. One, that they are CCAVs, so they're outside of the UK market and regulated under the articles of the European legislation. So they would not be looking for an SDR label. Or two, they have just decided that they don't need a label. They know what they do. They've removed the word sustainability from their product, but will carry on doing what they do. And what they do is still very good from an impact perspective, but they've made the choice not to have the label. So our process in itself has not changed. We still scrutinise every fund down to the stock level. We still address areas where we see controversies or difficulties with the fund manager, and then we make decisions from there on. The market has got substantially bigger, and therefore we are able to operate perhaps with far more choice. So for us, the process still remains the same, with whether it be our MPS or our bespoke services, but predominantly in both of our middle portfolio services, we will still apply the full screen that we highlight, and that will still include the negative areas. We will then look at the underlying areas, and we will then make our decision based upon the fact that all the underlying stocks meet the criteria, therefore the fund meets the criteria. So we cannot change that. We will still be applying that negative screen. But what you might find is one or two impact funds might not make it in, and there'll be a number of funds that perhaps don't have that impact label. So what are we going to do about this? Well, we're going to demonstrate this on our fact sheets, on our data, so people can see what labels funds have, but we'll also be quite clear as to why we have included some that don't have a label, or that have perhaps the focus label, or perhaps at some stage, if someone asks us why an impact fund isn't in there, we will explain why. We're always open about our rationale on an investment. The greenwash regulations were very welcome by us, and even we had to sort of tighten some of our terminology. For example, we found it very difficult to demonstrate tax practices because one of our screens was quite explicit. We avoided companies with aggressive tax practices. We still seek to avoid them, but we no longer say we do because it's quite a difficult thing to demonstrate. Because not all opinions are the same on this area. So even we had to change some of the way we discuss things. I think SDRs, one of the things we have to be careful about is when we look at it in the long term and the short term. In the short term, yes, we've had people say they don't want to label, they don't want to do this. If this picks up, and I suspect it will, and I believe eventually products will be built around the label rather than at the moment everybody trying to get existing products into labels, then I do believe that over time this will become an important factor in determining the market. So it's not something we're ruling as unimportant or as regulatory burden. It is actually something that we believe is very important. Well, I hope that gives you some clarity on what we're looking to do. The final area I would say is that obviously also our portfolios are multi-asset, which means that there are some areas where we can't always go fully into impact in bonds. There are some good bond funds out there that are impact bond funds. There's some very good green bond funds, but the point of bonds is to be quite dull and boring. And because of that, and we want them to risk mitigation, there may be bond funds in the portfolio that perhaps don't have the same label, but that's specifically because we really want to avoid the unnecessary risk that it could pose by having too much of a focus on impact bonds.
Thanks, Wayne, for joining us and sharing your views. Personally, I think Wayne's straightforward talking is really refreshing. He acknowledged the tension points, like Tesla or nuclear power, where values and impact collide.
Yeah, agree. I loved hearing from Wayne. The moral dilemma and grey area is real life, isn't it? I think advisors need to be aware that clients may come with a black and white preference. And it's where the advisor's role to help navigate that nuance and see through black and white thinking really comes into play. This is where clear disclosures are super important, isn't it?
Yep, once again, agree with you. I like it that you reminded us that language matters as well. Tightening claims and avoiding over-promising. That's a big compliance lesson under SDR and the anti-greenwashing rule. So good to see how these major providers of funds and portfolios handle values and regulation. Great stuff.
Yeah, I think brilliant is the word. So there's so much in here for advisors to take away. But we will come to takeaways after our final and very important guest.
Yeah, okay. So there's no values discussion would be complete, I think, without the consideration of charity or philanthropy as an add-on to advised regulated investment activities. We now have Jack Chelman with us to give some background and tell us about his work. Jack is the Chief Project Officer at the Global Returns Project. Over to Jack.
Well, hi, Ellie and Lee. So nice to be here with you on Accord Talks. Yes, I'd be happy to talk about the role of charitable giving and the benefits of talking about it with clients. I think the main thing to say is there's a huge amount of unmet demand for discussions about charitable giving advice. So about 2/3 of high net worth individuals say charitable giving is an important part of their life. About 1/3 actively identify as philanthropists. And even among the sort of affluent bracket, about 0.5 to 1 million pounds in assets, even they plan to make a major gift to charity in the next 5 years. About 1/3 of them plan to do that. So there's real interest in charity, and this is not a huge surprise to those who know the UK. But there's not a lot of supply to meet that demand when it comes to financial advisors and wealth advice. So only about 8% of affluent Brits get advice on their charitable giving, and only about 16% of advisors routinely ask about charitable giving goals during the discovery or planning processes with their clients. It's a real shame that this is the way that the UK works for whatever reason, especially because from a commercial perspective, there's been some really interesting research saying that talking about charitable giving is a business benefit. So work in the US did a study found that firms offering charitable giving advice had about 3 times the average growth, higher investment levels per customer, and about 6 times the median assets under management compared to firms that didn't offer that advice. And when we think about the demographics among clients that are most important as we move forward, as the great wealth transfer takes place, this really, really resonates. We know that about 71% of advisors find charitable giving discussions are helpful for building relationships with the extended family. We know that women think about philanthropy in different ways to men. So next-gen clients, women clients, this is really relevant. Now, when we talk to advisors about this, often the question that gets raised is, well, I get that charitable giving is important to talk about, but how would I go about it? And most importantly, how would I make sure that my clients get the kind of reporting and the assessments that they would expect from anything else that I do? And that's really something, just as an example, the Global Returns Project, we focus on climate and nature charitable giving. We help clients give to great charities operating in the environmental space. And one of the things we do really well, I think, is that regular, consistent, and rigorous impact reporting for every donor that gives through our model so that everybody knows exactly what they've done and what impact they're delivering. So there are outsourced options for getting expertise in this space. And if you're not sure how to help your clients or where to start, there are organizations that can help you, and some of them are free. The Global Returns Project is free to work with, for example.
Thanks so much to Jack for joining us. I think you are right in what you said earlier, Lee. Consideration of philanthropy and charitable giving really completes the values discussion. I love that Jack showed that there's unmet demand here as well. Clients want these conversations, but few advisors ask. And this information from Jack sits so nicely beside the Financial Lives survey stat about 76% of people wanting to be asked if they've got views on responsible investing, doesn't it?
Yep, very powerful statistics. It's an area where advisors can really add value. Excuse the pun there.
No apology needed. And I love Jack's point about reporting. I love reporting. Personally, I feel that this is a major inclusion. Clients should expect impact reports from their philanthropy just as much as they do from their investments.
Yep.
I love that this is being delivered.
Yeah, agree. So for advisors listening, don't be afraid to start the conversation. It can deepen relationships, especially with next-gen clients, and it complements and enhances values-based investing beautifully. Right, shall we start wrapping up?
Definitely. So what are today's takeaways? My first one is that ethical and values-based funds really matter. Clients want them. And also that simplicity is powerful. Clear exclusions can give security to someone's values. And I think it's fair to say that the SDR has definitely raised and sharpened standards, which is great for transparency.
Yep. And I'd like to add that advisors need to be aware that values can potentially create tension points. Okay, fine. And advisors need to help clients navigate the grey areas. That's one of the reasons why they need an advisor to help them through. And don't forget to fully use disclosures as tools to help communicate clearly. Oh, and don't forget charitable giving or philanthropy. It's part of the values conversation. It may not be regulated advice, but clients are going to react more favorably when you've got that broader, more holistic discussion, and it strengthens the advisor-client relationship.
Yeah, okay. And I've got an action point to end the takeaways.
Ooh.
Yeah, please head over to the Accord Initiative website to the Suitability Toolkit section to help advisors in their discussions with clients. The toolkit templates for the advice process include philanthropy, not just useful for a discussion framework. The toolkit's process is first and foremost a compliance solution designed to secure your advice for consumer duty. So I think that brings us really neatly to the end of our Good Money Week mini-series.
What a journey. Yeah. Over the past 4 episodes, we've looked at fact-finding, due diligence, disclosures, and values, the building blocks of delivering sustainability and compliance in the advice process. But of course, these aren't one-off topics. They're part of a much bigger journey for advisors and clients, and we'll keep exploring them here on Accord Talks.
Yes, we will. Thank you so much to Louisa, James, Miranda, David, Wayne and Jack for joining us, and a massive thank you to all our guests over the last 4 episodes.
Yeah, thanks to everybody. And if you've just joined us for this mini-series and enjoyed it, you better have enjoyed it, please do keep listening. We'll be continuing with new episodes, new guests, and fresh insights into sustainability, regulation, and advice. Because the advice doesn't stop with Good Money Week after all, and neither do we. We'd love to hear your thoughts and any questions you may have. You can drop us a message via our website or LinkedIn. We'd really love to hear from you.
Yeah, thanks so much for joining us for Accord Talks. And thanks again, as always, to our Accord Initiative partners who make it possible for us to spend time producing these podcasts for you. We've loved it. We hope that you have too. Our next episode will be in November. We look forward to seeing you then.